Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll do the market update. Um, just briefly talk about the earnings. There's only one active trade out there. And Joe will go through some charts and his analysis. So let's get started. Okay, you can see, SPX, NASDAQ still in two, and then, Russell's in four. Uh, one thing I did want to point out, the dollar has been real strong, made a really big run. I'll pull up that chart too. Um, Overall green pie, big drop. We're definitely oversold at this point with the 20% year, and then state eight's up near 50%. So let's take a look at the market pulse overall. So you can see, we popped up here right around 80, kind of, like the last time, and obviously right around 20 on the bullish. That's kind of right around the bottom of the last big drop there in March. And if we pull it back even more, you know, these got up, up near 90, high 80s. So, obviously can go higher. But definitely in an oversold condition. Just looking at these, seems like below below 20 is a good entry point on the bullish overall. So yeah, we did get a little spike up in the new lows. Nothing crazy like back here, where we're getting like 1,000 or whatnot. As we have more and more symbols in state eight, that's when new lows are made. So just have to keep an eye on that. But uh, same thing with the 20-day averages. See, kind of like this since this cross, just had a big move down. So diverging, and we're just looking for things to start flattening out. And I think we'll have to see these. Look at the resistance support levels. That's kind of been the key to all this. Let's look at the individual states. Just want to pull up, show you that state eights. So that's transitions. So this is 1 and 8s. Obviously these were big moves back then, but kind of in here, you can kind of see here 45, 50. This is kind of like a normal. So we're kind of at the normal point. Obviously things can get crazy, where we're at 75, over 70. But we're kind of, this looks normal-ish at this point. So I think if we do break below these, kind of key levels, then it could get crazy. But we're definitely getting into near those support areas for SPX and the Russell. So let's take a
Hey,
look at.
Josh,
Yep.
talking state eights there. So
Mhm.
I happen to go back just in talking about transition to state eights rather than the overall percentage level. So,
Mhm.
we got like over the past week, somewhere in this, mid 60s to last night, we got 86 transitions into
Mhm.
state eight. Going back to the last kind of low in the market would have been mid-March. March 13th. And generally from March 9th to the 17th, we averaged probably 125 state aid transitions,
Mhm.
topping out at 140. March was the low. So,
Yeah.
haven't gone back over time besides just that snapshot, but in terms of state aid transitions, we are well below the actual numbers going back to the March lows, which to
Mhm.
me, if I had to read into it, coupled with everything else, would suggest to me that, maybe the market is, a little healthier than it was back in March, but that's just me. So sorry to interrupt. Just wanted to throw that in on the eights.
No, that's a good point. You can see a lot of these spikes are, kind of on or near lows. Even here, flattened out. Like here was the low.
Yes.
Here's a low. So, we don't, a lot of these are at or near the low. So you see that's, for the most part, not always, but it's just one more kind of indication. I think it's good. And, we don't know if we're going to have higher transitions today or not. Doesn't look like it, but yeah, it's a good point. So, okay, let's look at SPX. Obviously, been uh, a solid state two prediction here. So we're below the target three. That's where we usually run into resistance. I mean, below here is 4,200. That's the bottom of our range. So, we're still, 73 points off as of yesterday. I think we're a little lower today, but, that's our range. So really, if we stay down here below, this is typically pretty strong resistance. You can see like here, this day, it bounced off it, but, next day it just got crushed right through it. So, if we stay down in this range, I would expect a forward transition. Um, so that's kind of where we're at on this. Let's look at the big chart. Obviously, more important information here. So, I always like when things line up. So 42, 46 is our range. And you can see the 200 is right on the 4,200. So this is going to be very, very critical support level, if we get down in that range. So that's what I'd really be looking at, and we can pull it out a little further just to see. Yeah. So there we go. Just to show you, where we get all this stuff from. There's your 42. That's the 46 up there at the top. Barely touched it and been turned around ever since. So yeah, I think it's right here. This is the key level to watch. The SMA, the 200 is right around 4,200. That's the bottom of our range, obviously. So these are going to be, very critical levels to hold for SPX. So, if we get the, if we get the turnaround, obviously, we're at the bottom of the range, so we could have a pretty good run up. And, that's kind of what the market pulse is saying. But, we have to, if we do test those, we have to hold those levels. Obviously, going to be very important. Russell, so here we're in state four, kind of coming into like the normal, kind of average range is between 2 and 3. So, the bottom of our range is 1,700, the top's 19. So we're not as close to that, but they're kind of moving in tandem, right? So, I mean, if you just look at, um, the SPX, we're what, like 70 points off the bottom here. We're about, 60 off the bottom there. So, kind of moving in tandem. So, obviously we typically expect the Russell to show us a direction first. So, we start seeing that stabilize, and, SPX has just been kind of violent here, with the big down move, like 1, 2, 3, 4 kind of big down moves. This had, like a big gap, kind of 2 days, and it's just kind of been meandering a little lower, so not as violent. So, I would look for, kind of in this average range. Obviously target two's been met. So, typically in this kind of range here, is where we can see bounces. Obviously, this target 3 is going to be important, but these are getting so close to 17 that that's kind of you know a lot of potential for bouncing in this area. Just overall for Russell, lots of support levels. Um, so like here, the target 3, and then obviously 1700. But let's take a look at the big chart. So, we had talked a lot about this, and it's pretty much come true, the, the triple head here. Let's pull up these charts. So this is our 19, 17. So we had talked quite a bit, lower highs on these peaks. And then, the eventual drops afterwards. So, we had thought, potentially we hold up here, but it hasn't. So we pretty much made almost all the way move down. These other ones all hit that 17, if only briefly. So we'll have to see, if this does make them further move down. I mean, I could see, support in this range, like right above that 17, not necessarily touching it, but we'll just have to see how things pan out here. But it's been a good roadmap. So we definitely did pretty much same things here, right? So down, test, kind of down, test above, same thing down, test above. So to complete that, it would have to, touch 17, and then obviously it's should be the bottom, but no guarantees it'll get down there, obviously, but most of the move has already been made. So really, we're just kind of looking for those start to see support in Russell first, I would guess, and look for the turnaround. But obviously things can, we can get a wipeout down to 17, and then obviously that's good. Should be a good bullish entry, just based off of past. Let's see, how long have we been in here? Wait a while. It's like May 2022, kind of been in this channel. So that's where we're at with the Russell. And I did want to pull up the dollar. So this is the headwind, obviously, for those multinational companies up here. But, just kind of another little thing. We get up in this range, that target 3. So, if it goes up and like shows support, then obviously this can keep running. But this is a good, overall, a typical reversal point, between, average move and target 3. So this is something to keep an eye on. Like if this, stays above target 3 and this like shows support, then this thing can really run. And you can see here we're near like the 52-week high. So really, two kind of other things I would be watching right now is the dollar and obviously the 10-year. 10 years making new highs today as we speak at the 4.6. So another headwind for the market. So stronger dollar, higher yields. What else do we have headwind wise? Fed balance sheet. So
Say, Josh,
yep.
this is Dave. Can I slow you down just a second at the dollar there?
Yeah.
I was reading a few days ago where I think Janet Yellen was suggesting that, well, look for the dollar actually to weaken, but I don't see that in the near term. If they're not going to reduce interest rates at the Fed level,
Mm-hmm.
and so where does our dollar yardstick come from? It comes from our dollar measured against other other currencies, right?
Right.
So are the other currencies, they're not going up as much as ours is, or they're coming down faster than our dollar is. So I'm not sure I see the dollar weakening in the near future. I was curious if you or Joe had any comments on that. Even though Janet Yellen said to look for that, I mean, they're still printing more and more treasuries every day, and people are buying them. So,
yeah, I mean, there's a lot into that. The currency markets are very political, and there's there's political aspects. It's not an easy thing to predict. Those kind of swings, but yeah, I mean, I just kind of watch the 10-year on this one. We have been getting some movement, pretty good movement up on that 10-year, and overall, I pulled up those charts a long time ago. Basically once the 10 years over 4 or 5, then, stock markets start performing poorly, and over 5, it's bad news, right, for stock market. And then I would think, you know, um, depending on how, it's all a relative comparison, right? So, if we're in better shape than everyone else, then they're going to have their money in dollars, right?
right.
If if you're sitting in, uh, like a Japanese bank, and you're earning 0.01, with inflation still kind of going, wouldn't you want to move your money into dollars and get, like 5%, in a money market where inflation's, 3 or 4, maybe a little higher, but so I think that's kind of, the thought process, just kind of, where can I get the highest yield for the least amount of risk? I mean, that's really everything, that, boiling down investing, and where can I get the highest return for the least amount of risk? And probably at this point, even with our 33 trillion and counting in debt, it's the best house in the bad neighborhood, right?
Yeah, I was just going to make that point before you did, about where there's some, let's say, confusion slash frustration at, well, how can the dollar be so high when our national debt is so high? Those are kind of like opposite forces, and yet here we are. Just saying. So, good point.
Yeah. Well, I mean, if there is a move eventually for the world to decouple from the dollar, that it'd be a different story. But at this point, nothing like that. I mean, there's talk of it with BRICS and all that stuff, but we've discussed that quite a bit in the past, so I don't see anything happening like urgently on that.
Yeah, me neither. Thanks.
Yeah, so keep an eye on the 10-year. This has closed, if you remember, like the 2-year, we were up around 1% difference. So now we're down to 0.6. So this curve is starting to flatten a little. So, if this gets up, I could see this flattening, as long as the expectation for rates and stuff higher for longer, then these will start, pulling up. As far as Fed meeting, this moved a little bit. So we got 75% for no hike. This is November meeting. It's over a month away. So, but they had still talked about, possibility of one hike this year remaining. So somewhat priced in. Longer term, I think these expectations have been moving up. You can see over here 28. So that's now, it's moved up a quarter point, kind of the little bell curve they got going here. So that those expectations have been tempered some as far as the cuts. So that's where we're at with the Fed. And balance sheet, they had a nice little week here, so dropped off about 70 billion. So we're right near 8 trillion. If you pull it back perspective wise, yeah, pandemic, yeah, we got up to 7. That was kind of the quick one. Obviously, before pre-pandemic, we're at 4, but this was kind of the start of pandemic, right around 7. So I think generally we're back to levels. Let's see, what is that? June of 2021. Um, they're running off, and they're continuing to do it. So uh, obviously, headwind overall for the market. Lots of headwinds. Did want to pull up a few charts. So I think we talked about this last week, but this 10-year bond total returns since 1928. So you can see the last 3 years, we've never, obviously in the 50s here, you got some bad returns, but nothing like we've seen here. 2021 minus 4.4, 2022 almost 18%, and then we're down so far this year. So you think just the banks they're holding a lot of these 10 years. So whoever's holding these, if they need to sell them, they're getting crushed, right? I mean, at least 25% or more down on these bonds. That's a big haircut. So other one I want to put up. So it's from the real estate guy I follow. Inflation adjusted home prices in 2023. They're over 85% compared to their 130-year average. So this is just for reference. This is the last housing bubble in 2007, 2008. So what this is, the inflation, either home prices have to come down, significantly, or inflation's really got to take off. So that's his kind of thesis on this. But obviously problematic. And I've showed you guys before, debt to income ratios and are just all out of whack. So, one thing that he had been talking about is the Airbnb, VRBO kind of, craziness that's been going on. A lot of these people, he did research on these homes. Basically, you don't have, a lot of these people are paying like 1% down for these rental properties, based off of potential income stuff. So sounds eerily similar to what happened in '08, then individual investors, but seems like there could be some trouble brewing in that Airbnb whole investor thing going on. Especially as people run into problems with their income and inflation hitting them hard. People are gonna be taking less and less vacation, but could be a potential area of trouble. So just want to
interesting. Sorry, Josh. Just such an interesting chart. Such an interesting chart. I just find it hard to believe that the housing market is anywhere close to the bubble we saw in 07, 08. But with the no doc loans, and you're saying 1%. I find it hard to believe. But, interesting.
Yeah. It is hard to believe, but we didn't know how bad it was until we saw The Big Short, and some female adult entertainer had 5 houses in Miami. So who knows what's going on? It's hard to say.
Well, that was no doc loans. I really do think the industry corrected itself an awful lot. That's why. I'd be surprised. Impose certain rules and regs, but like you say, you don't know until it's happening.
I mean, from what I understand, like people buying them to live in them. I mean, it's definitely a lot tight, they've kind of cleaned that up, but I don't, this could be that area that, just went crazy, you know.
Yeah, and a lot of that was, I think, commercial money. I mean, Zillow got into the market and supposedly was trying to get out. So if anybody sees any hard numbers on, Airbnb ownership and things of that nature, please maybe share with us, one of these meetings.
I haven't seen any hard numbers, but I've seen a number of articles that I obviously didn't bring with me, like in, for example, New York. One of the reasons, any major city, one of the reasons the rents are so high is that people have bought properties and they only rent them on Airbnb.
Right.
And that makes the remaining properties scarce. And so the rental prices are staying up. And even they found, even when they rent on Airbnb, if they're not rented like half the month, these people, they don't live in them. So, I mean, it's okay with them. They're just doing it for Airbnb. I've seen this in an article which looked at Paris, New York, these major cities. I'm sure probably Florida is that way because people like to vacation there. And that created, that has created all this shortage because of housing.
The inventory.
Right. And that's keeping the prices up. And that's even with all the remote work. Right? People can go work from the suburbs or whatever. But the VRBO Airbnb thing is a very real impact on real estate prices from what I've read.
Yeah, I'm sure down here in Tampa, that would be very affected, by all this. So I think it would be pockets. I don't think, some areas would be as affected as others, It's kind of where people vacation and so, but I'm sure it's widespread. But something to keep an eye on, and it's I guess it's pretty hard to track. I haven't dove into, their sites and trying to find reporting that they do, but I'll keep an eye out for it. And
This is David.
Seems plausible. That's what worries me. It seems plausible, Go ahead, Dave.
Yeah, I was going to say that in my opinion, the housing market has different segments, and they react differently to different forces. And just like that, Airbnbers are like the same. Here in Florida, if you had Airbnb and now you're paying 3 times as much or half as much or 50% to 100% more on home insurance so that you can rent your property, that kind of takes a bite out of your, a bigger bite than some other state that, doesn't have the insurance premiums that we have. So just like the housing market has a whole bunch of different segments, so does Airbnb. And I think that's why it's hard to track, because there's no like go-to segment that's pretty representative of all the Airbnbers.
Well, I think it poses a whole different problem than like 2008. Like a lot of people were living in those properties. These are just being rented. It'd just be interesting if, like, how this would be dealt with if it comes, where they start walking away from these.
Yeah, there were Airbnbers before the pandemic and after the pandemic, and they're probably a whole different crowd.
Yeah. Well, I mean, right after the pandemic, I mean, prices really jumped, so I'm sure there's still a ways, like equity wise, till there was just like a significant jump in all the prices after pandemic. So I don't know how long it takes for, how much price would have to drop for their equity to be negative, It obviously depends when you bought it, but I think that would be a tipping point. People are like, well, now I'm underwater, and they're not making the, enough for the monthly rent, I think that's a tipping point for what people would be, like, all right, gotta get out of this. So,
Josh, Dan here.
yeah, Dan.
Just a couple of thoughts here. I'm kind of looking at the housing bubble and housing in general as house having intrinsic and extrinsic value. The intrinsic being the actual value of the house to build it. The extrinsic more of a speculation. And
Yep.
So I keep thinking, okay, if the housing market drops, I'm just going to throw it. Let's say it dropped, 50%.
Mhm.
Would the insurance companies, would the cost to insure that property go down? Because it's not cheaper to build it, because it doesn't mean the price of lumber and copper and everything have gone down. They could actually
Right.
go up. So to me, that is kind of a resistance to the downside. But then you have the other dynamic of, as you just mentioned, those that can't afford housing, they could end up losing the houses, um, so it's looking at it, and then there's a speculation. A lot of people buy the house, especially in Florida. It's like the 1920s. The housing just goes up. But as we know, in 2007, 2008, that's not true. But I don't know. It's just interesting as when I think about how far can it drop, and what would be the impact on insurance, because right now insurance is a big concern for a lot of people in Florida. It's just
Oh, yeah.
and not just Florida. Actually, I'm up in Connecticut, and it's the same way up here. Even though we're not Connecticut, we don't think that our insurance is related to Florida, but I think through the reinsurance companies, all insurance is going across the board.
Mhm.
And I have Citizens insurance in Florida, and they were the cheapest until I got this letter last week where they said there's a hurricane tax. So if there's a hurricane anywhere in Florida, even if I suffered no damage, I'm subject to about a 50% hurricane tax based on my policy. So if I have a $3,000 policy, I could expect to pay an additional $1,500, even if I wasn't affected. So in other words, a hurricane anywhere in the state could affect my premium. So that's kind of scary.
A 50% tax for
50%.
for each hurricane, whether you're impacted or not.
Yes.
Wow.
And what they're trying to do at the same time, they're trying to get rid of people that are in Citizens. So if they find a company that's within 20% of their premium, you're going to be forced to take that. It could be 20% or less, 20% more in premium per year. Then we'd be forced to go into that other policy. That's yeah. So anyway, buyer beware for Citizens. They came in the cheapest, because I canvassed a lot of different insurance carriers this year, because I had American Heritage, and they went up $1,000 on me in 1 year. So I said, wait a minute. And then Citizens came back $1,000 cheaper. And there's all these little caveats that I'm learning as we go through the year. But anyway, my little rant and my little observations on speculative housing markets and intrinsic and extrinsic value of them.
Yeah. I mean, everything's going up. Your power bill, like everything. Like
Oh yeah,
my
our
power
insurance up
bill
here,
like double.
yeah. And also they mentioned that it can affect everyone. Insurance premiums. If there's a storm in Florida, I read an article where it can affect your car insurance, and it can affect even health insurance. They're going to look at any way possible to get money in the coffers to cover these storms.
Right.
So And I know up here, housing insurance, I just had my car insurance premiums due, and they're going up big time up here as well as house insurance up here is going up. So,
Yeah, well, the bottom line is risks are going up and supply and competition is going down because insurances are just consolidating and leaving. If they
yeah,
can't
that's
make
right.
their
Yeah.
targets, they just leave. And that leaves less insurance companies, higher risks. And it's kind of strange that the insurance industry believes that climate change is increasing risks, but the oil and gas industry says, no, 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 it's not us.
Yep. Yep.
Hmm. All right, well, great discussion. Good insights, everyone. Appreciate it.
Thanks for bringing up housing, Josh. Such a big segment.
Hey, Joe, Dan here. I got a question on the previous topic that you touched on when you were talking about the state. What's the
The
word?
states, right?
Yeah,
The transition.
you went back to March 13th and state transitions.
Yes.
You mentioned the multiple transitions of March 13th compared to different years and even today. Now, when you mention the number of state transitions, are you talking about transitions just in like the SPY or transitions in multiple entities?
Yeah, thanks for the question. So, the database is about 4,500 symbols. And in our new user interface, and I'll pull that up shortly, we'll have a box for, the different state transitions. So out of the 4,500, each night, a lot of those 4,500 transition. And so we're talking about, just last night, 86 of the 4,500 transitioned into state 8. But I think Josh may have pointed out earlier, I think we're up to like 48% of the database is in state 8 right now.
Mm-hmm.
So that 86 number, Dan, was just the number of, the whole database that went into state 8 last night. And that's what I was referencing. Those numbers were significantly higher on a daily basis around that March 13th low.
Gotcha. Oh, thank you for the clarity.
You're welcome. And, we've been
Now,
saying
is that
for,
going to,
go ahead.
will that database show up on the new version? Is that something
Yes.
that will? Oh, okay, wonderful.
Yeah, and yes, it will for sure. And it's going to happen in our lifetime. Right, Josh?
Hopefully this year, lifetime.
Yeah.
Yeah, just quick earnings. There's only one symbol active out there. This AXP down a little on the bullish pre-runners. It's a 20-day trade, so that's the only one. We had two come out today. We had one at PII. We had it as estimated, but they have it as confirmed in Yahoo. So, but I didn't activate the trade. So things will start picking up on earnings, but we only have one active out there right now. So that was all I had. Any questions before Joe takes over?
David, a couple of quick questions. I was not
Yeah.
there for the first 5 minutes. I was trying to get my computer to let me put my audio in here. Anyway, the SPX, I was remembering back, at least by challenging my memory, back to the days when we actually were meeting in person. And as I recall back there, the 4,000 level on the SPX was one that we had a real difficult time breaking through until we finally did. So that was pre-pandemic. So that's what it is. So now we are where we are. We're what 200 and some odd points away from 4,000. And I was trying to, in my mind, well, what's the catalyst for moving up You know, is it rate cuts? Well, probably not in the near future. Is it prices coming down? That's not looking too promising. Is it, what is it? What would be the logic or the catalyst for bulls to want to push up from where we are, other than,
Earnings.
hey, we're 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 lower than we have been.
Yeah, I would say
Earnings.
two things, right?
Earnings,
Yeah,
end of the war, earnings,
right.
Yeah, that could
Budget.
be earnings. Yeah.
Right.
Trump elected. Sorry, I'm gonna get political.
Yeah.
By the way, you mentioned earnings, and tonight is the last quarter's Micron's earnings, and so I wanted to mention that too, and before the meeting got ended today, because a lot of the AI hype was based on hype, right? The pricing of the Qs and the SPX went up mostly just because of all the AI hype. So,
Hmm.
so I look at, if AI were actually taking place and being used a lot, and more applications were being developed for AI, you'd see a lot more memory being bought up. So we'll see what Micron says. I'll see what Micron says tonight anyway about that. If they're not doing better, I'm going to say AI was more hype than anything else. So my perspective on AI and what drives AI. And if you don't see it in the memory makers, then it's not really happening, because you need a lot more of it to effectively use AI applications. In my opinion. So these are just my opinions, and I could be dead wrong in all of them, actually.
Tulip mania.
Yeah. Well, I mean, it's just, there's a lot of, just pull up, like, remember 3D printing? Like, this is kind of how it goes, right? Craziness. Oh, we're gonna print everything, look where we're at, right? It takes a long time for things to, become economy of scale. AI may be cheaper, take shorter, but what is AI really, that we see that it's doing? It's like generating pictures and text, so um, there's
That's
always,
true, but when it hits the bottom line, or when it hits the quarterly calls on a Q over Q or year over year basis, then that's when the prices of the stocks get affected the most. So
Mhm. Yeah, but I agree with Dan. Yeah, tulip mania, we see it all the time, right? Okay, all right, Jim, you ready?
All right,
Hey,
Josh.
one
Got a handful
thing
of
real
charts.
Hmm?
Please, dear, go right ahead.
Josh, you mentioned that two earnings trades came out today,
Yeah,
and I didn't want to speak right away because I was checking my spam and all. There was no alert this morning.
there's no email?
No, I checked trash, spam. I was doing that while we were talking, and I wanted to make sure I checked those before. So there was a the weekly alert on Sunday, but normally the daily one, and
Right.
there was nothing that came. Did any, at least not my way. Did anybody on the call get one?
I didn't even
I didn't
verify.
notice.
Yeah, I don't think it came through. I just pulled it up on the pre-alert page.
Yeah, I don't see it.
Huh. Yeah, I'll check into it.
Yeah, there might have been a glitch in the system or something.
Mm-hmm. Okay.
Sorry, Joe.
Oh, no problem, Samir. Thanks for mentioning that. So again, here's the new UI as we've seen. And Dan, you can see kind of middle to the bottom there, state transitions. You can see state 886 last night. And then if you go back, in the time machine, it went back to 313. We'll get those state transitions. And eventually, when we get, a lot of this work done, in addition to just throwing out different numbers, kind of to offer more of a historical insight is kind of what I'm after. Besides just saying it's a smaller number in this particular sell-off. But there we are, almost 48% of these things are in state 8. So again, going back into the time machine and seeing different lows, it's a great way to do some research and try to if we're apt to get into the market at different levels, try to build some confidence in certain levels. So virtually no green in on the homepage, the new UI, area, it's strictly energy, which is no surprise. And we'll pull up a bunch of different charts. And again, one of the things here, that we talk about is the amount of the current mood. I mean, if we just take XPX, we're state 2, obviously, we're at the low point inside of state 2 here, down 2.92%, which is, the max, as is NDX. So last night we're basically closing on lows, and then we compare it to our average move as well. So, it's an ugly market. I honestly didn't expect it to be this ugly. I really thought that the August 18th lows, the intermediate lows, would hold, and clearly that hasn't been the case. So, basically, I've gone back to, look at some retracement levels is kind of what I wanted to do. Dave often talks about the VIX. I haven't pulled that chart along, whether impact, the proliferation of these zero expiration options, 0-day, 1-day expiration options. I honestly don't know, but just thought it was interesting. Here is this low we've been referring to back in March, the last intermediate low. The real low in price low in, pretty much all of the markets was last October, and you had VIX up into the almost mid-30s, considerably lower, in the March low in the mid-20s. And, we don't have quite the low at this point, but a couple more days like this, and, we'd have a pretty meaningful low. But, I just found it interesting that the VIX is, still, well off any, meaningful spike. SPX, Josh, as always, didn't going through it. State 2, like many of these intermediate states here, bearish intermediate states, they're short 8 days. We've exceeded the average move, of which the 58 of them were through target 3. So where does that leave us? And so from my perspective, here we are, the March lows. When I look at the high, and it was NASDAQ that topped first on March 19th. It was SPX that was next on the 27th of July, and even Russell, I think, a couple days later on the 31st. So when I look, from the highs, what kind of I'm looking at rather than a 5-wave up, maybe an ABC down. So the ABC down, if this is A, you got a B here and a leg down. Leg down is 272 points. Coming off of this high here, we'd be targeting 42.69 as a symmetrical ABC. Well, as it turns out, we're below that at this point. That 42.69 level. So, still looks like an ABC to me. So, then the next thing, that I like to just go back to the Fibonacci retracement. So where are we in SPX coming off of the March lows? We know that the ABC, we've exceeded a little bit. So we are, banging between the 50% retracement and, we've exceeded the 3/8 retracement, which was just basically 4,300, just above 4,200, would be this 50% retracement coming off of the March lows at 4,200 level that Josh has been talking about for many, many months. If you look back in here, the old high, is an old high was 41.95. So basically that 4,200 level. And then I didn't want to put too many lines on here, but if you go back to the October 13th lows of last year, in the SPX, you're talking 34.91. 3/8 retracement from, 34.91 up to 46.07, which was the high, would be 41.80. Okay, so there are a whole bunch of numbers converging, which is what I always look for, when you're talking about, washouts, big moves, especially to the downside. 41.80, 42.10, certainly, and basically Josh's 4,200 number seems an awful good level, to get entry into the market. That's SPX.
And we spent a lot of time. Sorry, I want to go before you.
Please, Dave, go right ahead.
Yeah, we spent a lot of time at the 61 percentage retracement. If you go back to the very first S1, back on the very left side of that, we spent a lot of time there, and not very much time at where we are now.
No, we haven't. Right.
So, to me, it just looks like we're going to go somewhat lower yet before we get to the bottom.
And back to the catalysts, to me, it's all about earnings. I mean, in terms of upside. I mean, we've been hearing for a year, third quarter earnings are going to start to turn around. And basically the street is looking for a substantially better earnings period in the fourth quarter. I mean, that's for a long time. We've been talking about it for a long time. To me, that's going to define any, the market's going up. Now, one of the things, and I'll try to do homework for next week's call on the earnings themselves. The quarterly earnings estimates aren't really changing, but one thing we may have talked about it briefly, out of the 500, companies, there was fewer mention of recession in these post-earnings call in the last quarter than there had been in a hell of a long time. So, the suggestion is that corporate America is believing in this soft landing. If we don't get earned, we're obviously rolling into the earnings period now. It'll be interesting. I mean, these post-earnings calls are going to be, I think, just critical to the direction of the ball. Can we get to 46? I think the only chance is good earnings, and we'll see. But so that's SPX only. Going back to leadership was the NASDAQ, not the SPX. So, here we are, stay tuned, very similar, average move, same thing. Josh did a nice job, talking about that. But, you just look at the chart and it's like, wow, okay, here we are. The old low is 14,557. Let's see, we are obviously below that now. Back to retracements. Here we are. Long way from them, and basically, so you go back into this period, which didn't mean anything to me until I pulled up this chart today. You had some gap action, back in this, say 1350, somewhere in that neck of the woods, that would dovetail with the 3/8 retracement. That's a long way from here. So still NASDAQ is leadership, and we haven't done a 3/8 retracement. We're not even close. From the let me see. This is the December low, not the March low. In terms, let me just, okay. I had the other one up, but I think that vanished. The NDX low, excuse me, not the 3/8 retracement for NDX, which is basically trading at 14,468 right now, 14,468. 14,313 is the 3/8 retracement, all March low. So, long ways to go. An ABC coming out of NDX would be 14,2 243. So again, long way to go to the downside. I'm looking at NDX and I'm looking at XLK, which we talked about forever, strengthen the marketplace. I'm looking at those two here to see whether, they leak hard and, we're going to get to those retracement levels or not. XLK, let's see if, I found a couple which I thought were damn interesting numbers in XLK. So, we had the monster, leg one coming out of the, actually it was a early Feb high, and then, we ran in leg one for a long time. We're now 212, doing ABC coming off, I believe it's a 19th high again. XLK, NDX, they topped first July 19th. SPX was 10 days later on the 27th, Russell a couple days later. So, an ABC coming out of the July 19th high would be 159. What is it? It's 18-point pullbacks. So 159. I think we're very close to that right now at 159. 159, as it turns out, lo and behold, is the 3/8 retracement coming out of the March lows. Let me just double check. Yeah. Coming out of the March lows. So I'm looking at NDX and I'm looking at XLK to see whether these, pullback levels hold, in what looks to be already a bit of an oversold condition. And when we talk XLK, Microsoft is 23%, Apple's 22%, and then you drop off dramatically. It's, NVIDIA at 5%, Broadcom at 4%, Adobe and Cisco are around 3%. So I just wanted to pull up the Microsoft and Apple charts for everybody because, they dominate basically this XLK index. We are like, it's so similar to the indexes. 5 days in, 8 or 9 days is the average. Current move is, a little bit less than, average. We're starting to meet some targets. So, will Microsoft hold? I'm looking at Microsoft and I'm looking at Apple. There is the Microsoft retracements coming out of, not the October 22 lows, but the December lows. You're basically banging at a 3/8 retracement in Microsoft here. It's obviously not a symmetrical ABC. That would be closer to a 50% retracement, which would be, this level here, which is about 290. So that's Microsoft, Apple, same thing. Day 2 in state 4, not state 2. Long way to go in terms of its average move. So I think Apple's going to be important to watch here. And then from a retracement standpoint, if you go back to those same, basically January 5th of 2023, that was the low. We'll see if Apple can hold this. I'm not sure where it is right now. Basically 172 was, the recent low. I think Apple, I don't know whether it's trading above that, but it's shy of the 3/8 retracement, which would be basically closer to 170. So, they were just kind of big picture looking for, hints, whether we're going to get support or not. I'm looking at NDX, XLK, and, an extension of that would be Microsoft and Apple. The useless Dow, I just pulled it up from a Fibonacci perspective. If you take the March 13th lows, we're beyond a 50% retracement in the Dow right now. Not sure what that means, but just thought I'd pull it up. And then Josh had talked about these charts earlier. You got the dollar just on an absolute tear, trading through target 3. 38 days, interesting. Average days is about right. 3 days over the average of 35 days. So, but yeah, just a ferocious tear. We had obviously a bad 4 and 8, at the low, but it turned around and that's just absolutely a rip to the upside. Just a couple others that Josh talked about. There's oil. We talked about this last week. We had traded up to target 3, and it's backed off a little bit. So that would be a little bit of a positive for the market if that, back and fills. And oh yeah, TLT. I wanted to pull up TLT going way back. So there's the chart back to 2008, and we're obviously back to a level of support, if you will. Can you count 5 ways to the downside coming out of the 2020 high? Maybe, but it's obviously not an ABC. It looks like you're in some form of a fifth leg, and how low it goes, in terms of price, the heck knows. But I thought it was interesting, to go back or just see it should be in this area. So yeah, they were the couple charts I wanted to talk about today. Happy to talk about anything further. Dave, thanks for mentioning the MU earnings tonight. I think that is very, very relevant. Like you say, how much memory those guys are talking about may go towards defining whether those July highs driven by the AI hype or, is just that, a hype top or something more meaningful. I really don't think we're going to know for a while until we get earnings. So, as I say, happy to any comments or questions, please. If not, Josh, back to you.
Okay, anyone else got questions or comments before we close up? All right, well, thank you all for attending. We'll do it again next week. Good discussions and questions. Thank you.
Thanks, everybody.